anyway, and like I said, maybe I'll put out like a little something to figure out what if there's a better time. My problem is I have limited times that work, like all of us. And so I have to start with that and then see what everybody else can do. So typically what I do in this meeting is I do what I would call like a mini lecture, like kind of just go over some of the high points of the chapter. It takes about 15 minutes or so. And then kind of turn the time over to you to answer kind of, if you had specific problems you were working on and you were stuck on, because a lot of times if one of you is, whoever's in attendance, there's other people who are stuck on them too. And so, and the meeting doesn't have to be an hour. Like if we go through that little 15-minute thing and everybody's like, no, I'm good, then we can be, we don't have to stretch it. And I know everybody has busy schedules, and occasionally it's gone over an hour. And it's also recognized that this is the kind of meeting, like if you have something else to go to, it's like it's not mandatory in any way. So if you're on there for 15 minutes and then had to take off, I wouldn't judge you, right? I wouldn't think, oh, what, this is a terrible student. Like, I get that the whole reason we're doing online learning is because we got lives. And so we're often juggling multiple things. I did my whole master's and all of my PhD work online. So I'm very familiar with it. And in some ways it's awesome, the flexibility. In some ways it stinks. You don't get the same conversation. And I learn a lot from hearing other people's thoughts on things. All right. So I just want to give you really briefly a little, I guess, a tour of a couple things in the class that some people miss are there, I guess, and that can be really helpful to people. So this looks a little different than your view because I'm in teacher view. So I have these extra menu items that you can't see on yours. But so these announcements, I try not to waste your time with them. In other words, I try not to put it out there unless I think it's meaningful. So please read the announcements. And like I said, most people do, I think. I have no way of knowing, but anyway, so that's there. But in the modules, in the modules, right underneath the textbook information, I've added this little Brother Fox's helpful stuff module. And right now it just has 2 items in it. Sometimes I'll add others, but one of them is this additional study content. And I feel like this is something that every year I show it this first week. And then every year there's somebody like 8 weeks in going I wish I knew that was there. That's really helpful. So I just want to kind of show it to you. Maybe some of you had already looked at it. All it is a link to a Google Doc. And I've added additional content for each chapter. One includes the little overview, which is in essence the little mini lecture that I give here in this class, in this meeting. But again, if people aren't able to make the meeting or whatever, I just have that there for easy reference. And then there's usually some problems that people find tough. So for this week, and if you watch the discussion boards, you'll see people are struggling with problem 11 in the quiz access. And so you can often find links to the tougher problems. You'll see chapter 2's got a bunch, right? Because, well, that should tell you what to expect. Anyway, but so I just want to show people, remind people, I guess, that that's there. There's a ton of info. I also share it with that, what's it called? The tutoring discussion board page. I don't know if any of you have checked that out, but it's there too. You can reach that by clicking on, where is it at? Tutoring resources. I feel like my computers or my internet's slow. And then this takes you to this page where you can post questions and the tutors will respond. Just because, as you know, again, as an instructor of the 100 students, I teach full time. And so I usually, if you ask me a question in the evening, and there's a good chance I won't see it until early afternoon the next day after all my morning classes are over. So sometimes you can get more immediate help from tutors. And then there's also how to like schedule an appointment right here, arrange a live tutoring appointment, like one-on-one with a tutor. And usually they'll have some links to like some tutoring sessions that they do, like group sessions. So they're actually really great. And so just, again, if you hadn't seen that or noticed that was there, that's there. So there you go. All right, so let me, so I guess before I even get started with like talking about specific content from the chapter, do you have any like general questions? So not like questions about specific problems, but general questions I could answer for you before we kind of get into more specific stuff. I was always told stuff was a no-no for public speaking, but oh well.
I do have a question on the quiz, not the quiz, the access quiz.
Quiz access, yes.
And in your email, you said that we can take it twice or 3 times.
I think the quiz access is set up for, I'd have to look real quick. Now I don't remember what I said in my email.
So if I already have a grade, can I go back and take it again? Will I get like 10% taken off or something like that if I retake it?
No, you can just improve your grade on it if you want.
Okay, so what about the oh shoot, what's it called? The financial statements. How many times can we take that?
I believe that's set up for 2. Again, I'm having a hard time getting it to load here, or else I would tell you.
If it's already been graded, like it's showing up in my grades, can I still go back in and take it and redo it?
Yes.
Okay. As long as it's not past the due date.
Right.
Okay.
And it won't be the 10% off on the financial statement ones?
It shouldn't be. If it is, then I'll have to. So one of the challenges of this course or just working with BYU Idaho in general is they want to have really strict control of their courses. So they lock down a lot of things. Like as an instructor, I just don't even have access to changing. But I know last year we had a problem with them having created those assignments where they were doing like a 10% point doc. And then we were like, hey, is that supposed to be? And they're like, no, we screwed that up. Sorry. And they fixed it. So if you're seeing something like that, something that's docking you points, let me know. I can't fix it, but I can send an email to the people who can. Let me look at it real quick. Financial statement analysis. So when I look at on my side, I can see these policies. It says 3 attempts are allowed.
Okay.
0% is deducted for new attempt scores. So yeah, that's set correctly.
Okay.
Because last week there was a few things that docked 10%.
Yeah, it was those weird like smart book ones, or was it?
Yeah, I think it was the smart book ones.
Yeah, so I can send an email in and see if we can get that fixed. Not that, here the other thing is yeah, those are actually part of your grade. So I'll double check on that. I'm going to make a note or else I'll forget. Week 1.
I think it was.
You ever try to write a quick note and then you can't read your own handwriting later? Okay.
I think it's the orientation ones to those videos. Orientation to concept videos and orientation.
Okay. Well, and
I don't know if that might have been correct.
Okay. Well, and the orientation videos don't actually impact your grade. So they were kind of like ungraded assignments. So that's one other thing real quick. Like if you click on the syllabus, you see over here on the right where it has assignment weights. Can you see that in yours when you look at the syllabus? You can see like orientations worth 0%.
Yeah.
Concept videos are worth 0%. Smart work are worth 5%. Financial analysis worth 5%, etc. So like I wouldn't tell someone don't do the concept videos. They can be helpful, but I would say if you're running short on time and you have to miss something, miss the concept videos, right? Like they're not worth a part of your grade. And then the other thing is, even though quiz access is only worth 5% of your grade, you have to do those in order to get the quiz to open, right? You have to score at least, 85% on the quiz access to get the quiz to open. So you can't skip that one. Anyway, sometimes when I have limited time or energy, something like this can help me sort of prioritize what I'm doing. Of course, in a perfect world, we would do all of the review and everything because it's helpful to help us learn. But it's not a perfect world, is it? It's a fallen world with fallen grades, but not falling grades. We don't want falling grades. Okay. Well, all right. Any other general questions before more specific stuff?
I was just curious about quizzes. What are the rules on that? Can we have our notes out for quizzes?
Yep. Quizzes are open everything. So exams are close everything. Okay. I mean, you're like allowed a calculator and a piece of scratch paper, and you could use Excel. That's it for exams. But quizzes and everything else, you know, all the other assignments except exams are completely open.
Okay.
So those are considered, you know, like formative assessments. You're learning as you are assessed, as opposed to like a summative assessment, like an exam that is not about learning. It's just about measuring, did the person learn this? Are we good to take a look at some of the content from this week? Now, some of you will be like, that is so easy. Like, why are you going over this? And others of you will be like, I totally didn't get that. So that's the problem when you're talking to a group, right? So I'll try to not go. So because of that, I'll try to go pretty quickly, but that means it's on you to speak up if you have a question. So it's super hard to see when people like raise their hand or whatever. So like, just interrupt me, like just be like, hey, Brother Fox, what is this? And like that's not, I don't think that's rude. I think that's learning. And so maybe that's why I was always considered the bad kid at school. I just wouldn't shut up, but I had a question, you know. All right, so let me bring up a little, unfortunately, it's PowerPoint. I'll try not to death by PowerPoint you. All right, so this, I can't stress enough the importance of the accounting equation. Like, this really does tie together everything, and it ties together everything, not just for this class, but for managerial accounting too. Like, this is a fundamental concept. So if you got to be able to wrap your brain around all of the parts of this, which it means understanding what assets are, what liabilities are, and what equity is, and then understanding the relationship between all of them. In fact, you've probably figured out already, if you've never had accounting before, that the class itself, like the math is easy. Usually it's not hard math, but the categorizing things into the correct category and then remembering the rules of that category, that's actually harder, right? So so assets equal liabilities plus equity, and assets are just things, resources that a business owns, okay, that they use for business. The most common assets include cash, which, I mean, that's my favorite asset of all time because it's so versatile, right? But it also would include things like accounts receivable, which would be money that our customers owe to us. And then like more like tangible assets like buildings and land and equipment and stuff like that, automobiles or you know, vehicles. Those are all assets. And then liabilities are debts. And those are usually separated into short-term liabilities. Sometimes they're called current liabilities. Things like accounts payable, money you owe to your suppliers, and more long-term things like notes payable or bonds payable, which we'll learn more about in the future. Liabilities often have the name payable in their name. If you ever see payable, you'll know that's like a key word to know that it's a liability. Not all of them do, but many of them do. Assets, if you ever see receivable in something's name, okay, that's a clue that it's an asset. But most assets don't. Most of those assets are just named after the thing they are, like land, equipment, cash. And then finally, equity, which is a less concrete thing, okay? Equity is just the difference between the assets and the liabilities, okay? So equity, if you think about it, is sort of like the part of the business that belongs to the owners as opposed to belonging to the bank or the lender. So all of your assets, your land, your buildings, your cash, they either belong to the bank or someone who lent you money, or they belong to you as the owner of the business. Okay, that's it. So if a business has $100,000 worth of assets, and they have $30,000 in debt, we would say their equity is $70,000. If they had $100,000 in assets and their debt or liabilities was $50,000, we'd say they have $50,000 in equity. So equity is the amount of the business that belongs to the owners. And it really comes about only in two ways. The first is called common stock, which means money that the owners have contributed into the business. So if I start a business tomorrow and I move $10,000 out of my private bank account and put it into the to the business's checking account, I've contributed capital, okay, money, capital, into the business. And I do that in exchange for common stock, which represents my buy-in to the business, okay? So we can either contribute the money to our business, and that's called common stock, or the business itself can earn money, and that happens by the business earning revenues and paying expenses. As long as the business earns more revenue than it has expenses, it's making a profit or a net income, and that adds to my retained earnings. And then finally, this part, dividends, is when the business says, hey, we've made some money this month and we're going to pay a share of that profit back out to the owners. So retained earnings is the revenue minus the expenses, which is our net income, minus any dividends. So it's the earnings the business makes minus any amount it's paid out. The rest is retained or held in the business, okay? So this is what we sometimes call the expanded accounting equation, which is, I guess it expands out what equity is, which is the common stock minus the dividends plus the revenues minus the expenses. All right, that was a lot of explaining, but it's better than having too many slides. So, all right, so what I want to do now is just walk through several transactions and sort of explain them. You've probably read about them in the book. You've probably done some homework problems with them already, but sometimes it's super valuable to just like hear it explained and be able to ask questions. So the first one is this, the business owner, Chaz Taylor, I guess it's Chaz, it's better than Chaz. Chaz Taylor invests $30,000 cash in the new company named Fast Forward and receives common stock for that investment. So the way I have to do this in my brain is I have to be like, okay, so recognize that whenever there's a transaction, there's always at least two accounts involved. And I'd have to ask myself, what's happening to each account? So I'd be like, okay, so the business, and this is from the business's perspective, not from Chaz's perspective. So from the business's perspective, the business's cash is going up, and then its common stock account is going up, okay? And so I'd say, okay, the owner invests in the business, cash is increasing, and then the common stock is increasing. So it would look like this to the accounting equation, right? So we have assets equal liabilities plus equity, and we see cash increase and equity increase. So the way this works, because it's this equals this plus this, is the balance on each side of the equal sign has to be equal, right? So when someone invests in the business, cash goes up, the common stock goes up. All right, let's take a look at another one. We purchase supplies for cash. So we go to our supplier, we purchase $2,500 worth of supplies. So cash is going to go down because we're paying cash to the supplier, and the asset supplies is going to go up. If you think about a lot of the transactions you do in real life, you'll be trading one asset for another asset. Can I just say, I just want to pause a moment since I just saw Daphne log in, and I don't believe I've ever had a class with 2 Daphnes in it. So that's notable, all right? I mean, it's awesome. Anyway, so there we go. When we purchase supplies for cash, we're trading one asset, cash, for another asset, supplies. We do a lot of that in life, right? Trading one asset for another asset. You know, if you buy a car, you're trading the asset cash for the asset car. So the accounting equation will look like this. Our cash goes down by $2,500. If you're not accustomed to accounting notation, when they put it in parentheses like that, it means a negative. instead of, I don't know why they don't just put a negative, but that's what accountant people do. I think it makes them feel fancy. And so now we can see we have assets of 30,000, 27,500 in cash, 2,500 in supplies, and we still have common stock of 30,000. So we're still in balance. You'll find out, like, if you haven't ever done accounting before, that like it's always about things being in balance. And there's something, there'll be a moment, maybe it hasn't happened yet, but there'll be this moment when you're doing everything, and then like your balance sheet just perfectly balances at the end, and there's this little moment, this little piece of like satisfied, right? Like kind of like those YouTube videos where they like perfectly cut through something, and you're just like, oh, like that. So I hope you get some of those moments with accounting. I honestly believe that the reason you feel that way when you see something satisfying, like things balancing just right, is that the universe is a place of order. And when we get a little taste of order, it feels, as Joseph Smith would say, it tastes good to us. And we are like, I like it. More balancing. All right. Sorry, sometimes I get a little manic talking about a bunch of stuff. But I mean, the other option was like someone like me be like, okay, class, today we're going to discuss the purchase of equipment for cash, right? Like, so, all right. So the purchase of equipment for cash, again, we're trading one asset for another. So which accounts? Well, my cash is going down and my equipment assets going up, okay? And so again, we can take a look at how it impacts our accounting equation. We have a negative 26,000 to cash and a positive 26,000 to equipment. So we add all three assets up. We have total assets of 30,000 and total equity of 30,000. This is the stage at which, if I were their accountant, I'd be like, whoa, you're cutting it close on cash there. I don't like to have that little of cash in my business. Personal account, I don't know. Depends on how badly I want that thing I'm looking at, right? So, all right, let's look at the fourth one. So if this is our first time we're going to purchase something on credit. What that means is we're not paying cash for it, okay? So when I buy an asset and I don't pay cash, it means I owe money to the person I bought it from. And so that means my liability will increase. So if I purchase supplies for credit, I know I have the asset supplies will be going up, and I know that the asset, or that the liability account, accounts payable, will also be going up. Sometimes it confuses people because it seems like because it's a debt, it should be going down or something, but we would still say our liability account is increasing, okay? And that represents money we owe. So here's what it would look like to the accounting equation. We have total assets of 37,100, cash, supplies, and equipment, and then liabilities of 7,100, and equity in the form of common stock, 30,000. Let me pause here and ask, is this valuable at all, talking through these, or is it just, am I just wasting your time? Like, because like I could do more of them, or you could be like, no, like we could go just watch your video later, but we'd really like to look at homework problem or something.
So I do, this is where I struggle, is if anything that says on credit.
Mm-hmm.
So it doesn't affect the cash at all.
Right.
And then, but because it's on credit, it's a liability. And I understand that it's adding because our liabilities are increasing. But what happens when we pay something that's been on credit? Does that affect the cash?
Yeah. So later on, when we pay for our supplies and we go to the supplier and say, hey, we're going to pay our bill, then we would debit the liability, which would make the liability go down. We don't, not doing debits and credits yet, but the liability would decrease and our asset cash would decrease.
Would also decrease.
Mm-hmm.
But it doesn't, are you going to get to the revenue part of it, right? Well,
yeah, we
like
haven't
tonight. Okay, but we're going to get there. Okay. Because that's where I get messed up. Okay.
Okay.
So the way that I kind of think of this, and then correct me if I'm wrong, Brother Fox, but the way that I think of the credit one is if I were to build out my own budget monthly, right, I would put in there that I have $1,300 worth of rent and a $100 cell phone bill, right? Mm-hmm. And then as I go, I'm just adding to that. So if when I pay off my cell phone, for example, there's a $100 credit, I pay that, I add $100 into that account and it clears out the $100. Does that kind of make sense? Am I right, or is that just more confusing?
Yeah, I don't know. Well, so I mean, purchasing something on credit like literally means you borrowed money. Okay. Mm-hmm. Usually you didn't go to them and they gave you money. They just said like, here's your supplies, pay us within 30 days. That's super normal in a business, you know, or your cell phone, right? Use your cell phone, but you have to pay us by the end of the month or something like that. And so, you know, and so when the idea of purchasing something on credit, it just means you didn't pay cash for it. Instead, you're going to owe them. You're going to pay cash at some point in the future.
Yeah. Okay. Sounds good.
All right, let's take a look at a few more and we'll get into those revenues and expenses too. All right, so here we go. We provide services for cash. Speaking of revenue, in Chinese, they say, 说早早早早就到, which means, and don't fault my pronunciation, means if you speak of the devil or of a demon, then it will come, right? We actually say that in English too, if you speak of the devil, right? But speak of revenue, and there it is, transaction 5. So we provide consulting services for $4,200 in cash. So I'll be like, my cash will be going up and my revenue account, which is probably called service revenue or something like that, will also be going up. So cash, the asset, increases and my revenues, okay, they're just going to call it revenues, will increase. And revenues increase our equity in the form of increasing our retained earnings. Okay. So now in equity, we have not only money that the owner has put in, but since we just actually sold something, we actually have money that the business has earned as well. That all becomes part of our equity. And that matches up with this increase to cash. So total assets, total liabilities, and equity stay in balance. Come on. Here we pay an expense in cash. So we pay rent of $1,000 and salaries of $700 to our employees. So I'm going to have my cash asset going down and my rent expense going up. The funny thing with expenses is when they go up, they actually reduce our equity, okay? Because they're a cost to the business. And our salaries expense, same thing. Salaries expense increases, which is a reduction to our equity. So if you go back to that expanded accounting equation, right, it's assets equal liabilities plus common stock minus dividends plus revenue minus expenses. So as our expenses increase, they reduce our equity. Hey, me and the guy that wrote the book, we're thinking the same thing. So you'll see here that these expenses, they put them in as negatives to equity. So our cash went down and our expenses reduced our equity by the same amount. Yeah, we don't need all that. Let's go. So here we provide services for credit. So before we bought something on credit, right? We bought supplies on credit. Here we're providing services on credit, meaning we're doing the work for a customer, but they're not going to pay us until later. So we're doing the same thing our supplier did for us. We're saying, here's the, you know, we did the service for you. Now, you know, pay us within a month or whatever. And then we also rent a facility for $300 to the customer for credit. So this is where the accounts receivable asset comes in. This means money that customers owe us, okay? And our consulting revenues, which is a revenue account, will also increase. And our rental revenue will also increase. The only reason we record these two separately is because it's just nice as a business to track your different sources, your different streams of revenue, right? To separate out money you made from consulting versus money you made out from renting something out. In theory, you could track them all as a single thing. I wouldn't do that though, because rental income actually is taxed differently. So, but that's beyond the scope of what we're going to do in this class. Thank goodness we don't get into much tax accounting. So now you can see how everything balances. Our cash went up and our revenue also, oh, not our cash, our accounts receivable on this one, right? Because they didn't pay us yet, went up and our revenues went up. And then everything is still in balance.
I have a question.
Yeah.
Okay, so fast forward 30 days, we receive the $1,900. Mm-hmm. So our cash goes up by $1,900, and then we subtract the $1,900 from accounts receivable. Yep. But we don't touch the revenue account, correct?
Nope. Okay. Yeah, so that's a good point, and we'll get more into that later. But the idea is we record revenues when we earn them, not necessarily when we receive them. Just like we record expenses when we incur them, when we get the benefit of them, not necessarily when we pay them. So, sometimes we'll earn money, but we won't get paid for it until next month. That's pretty normal. So yes, when we collect this money, our asset cash will increase and our asset accounts receivable will decrease. But that will have no impact on revenue because we've already have recorded the revenue.
Okay, thank you.
All right. Hey, again, the client in transaction 8 pays $1,900 for the consulting services. So we're getting paid. So as you said, the asset will go up, cash, and the asset accounts receivable will go down. So you've probably noticed that if an asset goes up, if one asset, in this case, cash goes up, then the only other things that can happen is either another asset has to go down, or a liability has to go up, or an equity has to go up, because this thing has to balance. So that helps when you start, like when you're when you're recording transactions later and you're like, oh, I'm not sure what to do. Well, short answer is there's a limited number of things you can do. If I have an increase to an asset, I can only have the other side of that transaction is either a decrease to another asset, or an increase to a liability, or an increase to an equity. So that can help in time. The other thing is as I talk through this, it's kind of like someone trying to explain a card game to you, right? Or a new board game. And it's like, you're like, there's too many things. And you're like, I don't know, man, like we just have to play a few hands, right? But after you play a few hands, then it makes more sense. And so my hope is together with the work you're doing on your quiz access and your quiz, and then with the conversation about it here, it can kind of all come together, right? They can both clarify each other. So don't feel bad if you're like, this is confusing. Correct, it is. All right, so here they pay $900 as a partial payment for the supplies they purchased back in transaction 4. So if they're paying money, their cash will go down. And then remember when that happened, we created a liability called accounts payable. So that will be going down too. So cash, the asset, goes down, and accounts payable, the liability, goes down, paying off some of that debt, $900 worth. So we can see there, cash goes down by 900, accounts payable goes down by 900. And then everything's still in balance. All right, we're getting close to the end of these, but again, I hope they're valuable. So here's a payment of cash dividend to the owner. So remember, all a dividend is a business sharing some of its profits with the owner. And why? Because why the heck else do you own a business, right? You own a business because you want to make some money. So this is the business paying out some of that money to the owner. So the owner withdraws a big fat dividend of $200. I mean, hey, it's better than nothing. But probably wouldn't make the car payment, but the accounts involved are cash going down. The business is paying out $200, and the dividends are going up. But just like an expense, a dividend going up reduces equity. Again, the expanded accounting equation is assets equal liabilities plus common stock minus dividends plus revenue minus expenses. So an increase to dividends will be a decrease to our equity. So at this point, we can kind of see like, okay, so now this business has revenue of $6,100 minus expenses of $1,700. So that would tell us what our net income is at this point, right?
I have a question.
Yeah.
Okay, sorry to jump in. Will dividends, will that ever be a positive number?
About the only time you would see a positive dividend or a positive expense as far as like adding to equity, okay, would be if we were correcting an error. Like, you know, we made an error and accidentally added too much dividend and we now have to, you know, had too much dividend expense and have to put some back.
Okay.
So really the answer is like never, unless
dividends are always a negative. Okay.
They're always they always are a negative to equity.
Okay.
Okay. And so expenses, same thing. All right. So here we have a summary of all the transactions we've made. It's a lot to take in, but you can see our most active account here was really cash. These are all the transactions we had during the month, and now the balance at the bottom is 4,800. Accounts receivable, if you remember, it increased when we did the service, and then when they paid us, it went back down, so now it has a balance of 0. Supplies, there's the amount we purchased cash, plus the amount that we purchased on account. So we have $9,600 in supplies at the end of the month. Cash, we just made that one purchase, equipment, sorry, we just made that one purchase of equipment. And so we'll still have a balance of 2,600. Also recognize that these balances, they represent what the asset cost us, not what the asset is worth. Think of something like a house that could actually appreciate in value. We don't record it here at its appreciated value. We typically record it here at its cost, okay? And now, so that's our total assets. Then our liabilities. We borrowed $7,100 back when we bought those supplies. We paid $900 on it. So now we still owe $6,200. Common stock is the money the owner put in, minus the dividends, the amount that we paid out to the owner, plus the revenues, the amount of money the business earned, minus the expenses, the cost of earning that revenue, if you think about it. So that's the summary of all the transactions for the financial period. So that leads us to the financial statements. This says the 4 financial statements. There are more than 4 financial statements, but these are the 4 basic financial statements, the ones that you will see over and over and over, get used in every business. If you go to Yahoo Finance and you want to look up a company you want to invest in, these are the 4 statements they'll have available for you to look at, okay? So we have an income statement, which summarizes the revenues and the expenses for the period. Income statements measure a period of time. So from the beginning of the month to the end of the month, how much revenue did we earn and how much expense did we incur? And the difference between those two is called our net income, or sometimes people will call it net profit. It means how much money the business made. If there's more expenses than revenue, then we would actually have what's called a net loss, right? Because the business lost money. The statement of retained earnings shows any changes in retained earnings. So it actually just starts with the retained earnings at the beginning of the period. For our business we just went through, they had 0 because they were a new business. They had no earnings yet. Then we would add the net income and subtract any dividends, and that would show the new retained earnings. The balance sheet summarizes the assets, liability, and equity. And then finally, the statement of cash flows just identifies cash inflows, money that's come into the business, and cash outflows. The reason we need this statement is because of the very issue we discussed earlier, and that sometimes we have revenue that we haven't collected yet. right? Like we earn the money, but they're not going to pay us till next month. And sometimes we have expenses that we haven't paid yet, that, you know, we bought them on account and we haven't paid for them. And so our cash flow might not always match up with our income statement. So we have to have that fourth statement. So here's just a picture of an income statement for, I think it matches this company we just did. You can see we had consulting revenue and rental revenue, which gave us our total revenues. Rent expense and salaries expense, which gives us our total expense. And then the revenues minus the expense give us the net income. You'll notice it's standard procedure to show the expenses as positives on here and not as negatives. Why that convention developed, I don't know. I think it'd be clearer if it showed them as negatives, but that's just how they do it, okay? So revenue minus expense gives us net income, and we need that net income in order to create the statement of retained earnings. So we have to make our income statement first, and then the statement of retained earnings is our beginning retained earnings, or retained earnings at the beginning of the month, plus any net income, minus any dividends, gives us our retained earnings at the end of the month. And then we need that to create our balance sheet, where it has our assets, cash, supplies, and equipment, our liabilities, accounts payable, and then our equity, our common stock, plus the retained earnings we just calculated here, gives us our total equity. And then again, our total liabilities plus total equity have to equal our total assets. So if you think about it, this summarizes that little transaction thing we were following where we had to keep it in balance each time. Also recognize that unlike the income statement and statement of retained earnings, which measure these changes over time, the balance sheet doesn't measure changes over time. It just gives us the balance of the accounts at this given moment in time. So that's a little bit different. Here, this is all the revenue we earned and all the expenses we paid for the month. This is the balance of the cash account, supplies, equipment, et cetera, at the end of the month. The other thing to recognize is people always think it's called a balance sheet because the amounts on each side balance, but it's actually called a balance sheet because it summarizes the balances of each of these accounts, of the what we call permanent accounts, assets, liabilities, and equity.
I have a question.
Yeah.
Okay. You do the income statement first, so you can get your net income, correct? And then you take that figure and put it into your statement of retained earnings. You take that minus your dividends. So your retained earnings, is that another name for net income? Are they one and the same?
No, because it's minus dividends. So so the next month, okay, when we do this, we go through and do business for another month. Okay. Then we create our statement of retained earnings. It's going to have a beginning retained earnings, which will match the previous month's ending retained earnings, plus any net income we earned during that month, minus any dividends. So what your retained earnings is it's the money that the business has earned over time, minus any amount that it's paid out to the owners in the form of dividends. So only in this first month will we start with a zero.
So will this retained earnings, this 4,200, let's just say we're looking at the November statement. Would I start December with this 4,200?
Yes. So yeah. So when we do the January, we'll be starting with 4,200, and getting that income that we made during January, and subtracting any dividends we paid out during January. Okay.
So that just keeps that retained earnings keeps moving forward to the next year. Okay. Yeah. Minus the dividends. So every month you subtract the dividends and it moves to the next year.
Yep.
Okay. So is it your retained earnings plus your revenues minus your expenses and then minus your dividends? That's your retained earnings, moves to the next month. Okay. Got it.
Yep. Thanks. All right, and then the last thing is our statement of cash flows, which has our cash. So here what they do is they break it into 3 sections, okay? The first is cash flows from operating activities. The second is cash flows from investing activities. And the third is cash flows from financing activities. And so cash flows from operating activity is any cash we've received from clients. What this means is cash we've earned and been paid in cash for work we've done. Okay, so revenue. And any collection of accounts receivable. Okay, so that would be the cash received from clients. Cash paid for expenses would be any cash we paid for cash expenses or any payments for accounts payable, money that we owed for expenses. That's what's going to tally up to our operating activities. Sometimes people get confused because they think of like financing as borrowing money, which is correct, but any short-term borrowing like accounts receivable or short-term lending like accounts payable, we just consider that part of operating. It's part of the normal flow of business for us to extend short-term credit to our customers to say, hey, pay us in 30 days or pay us in 2 weeks or whatever our normal terms are for that. So again, operating activities is any cash we receive from our clients, which includes the money we earn that gets paid to us in cash immediately, plus any collection of accounts receivable. Money that we earned, say, a previous month, and now they're paying us for it. And then the cash paid for expenses includes any expenses we paid in cash this month, plus any amount we're paying on accounts payable from previous months. So that's the cash flows from operating activities. Cash flows from investing activity is any money that we're paying out for long-term assets. And what I mean by that is land, buildings, equipment, vehicles. By long-term, we mean an asset that's going to continue to provide value to us over a long period of time, which means more than a year. Okay, so and so that would be cash paid out for equipment is what this one is. That's an investing activity. Also, if we were to sell a major asset like that, like sell a building, then that would be a positive cash flow. Okay, so the negative means cash going out, being paid out of the business, and the positive means cash coming into the business. So if you remember, we paid $26,000 for that equipment. So we show that as a negative because we paid that out of the business for the equipment. Finally, we have financing activities. This is either borrowing money for the long term. So not our accounts payable, but like, go to the bank and borrow money, or paying off those long-term loans. Or it is money put into the business by the owners, the shareholders, or money that we've paid back out to the shareholders. So in this case, we didn't do any long-term borrowing. So we just had a cash increase from the $30,000 capital stock purchase by the owner and a cash decrease by paying out a $200 dividend to the owners, the shareholders. And so the way they do this now is you'll see you have a subtotal. That's the cash provided by operating activities, the cash used in investing activities, and the cash provided by financing activities. We add those up, and that gives us the net increase to cash. Then we take what the balance was at the beginning of the period. This was a brand new business, so it had zero cash at the beginning. We add the increase to cash, and that should match up to our asset cash on our balance sheet. In my opinion, the statement of cash flows is confusing enough and advanced enough that I think the textbook authors put it at chapter 12 for a reason, something worth learning after we've learned a bunch of other stuff. But what this course, the designers of this course have opted to do is to just give you sort of a light view of chapter 12. You're not digging into it super heavily because they want to present all of the statements to you all at once. I don't think that's wrong. It's just different than how I typically teach it at in a course where I get to design how it's laid out. All right. That was more than 15 minutes. I apologize.
I have a quick question about the statement of cash flows. So if we did have a beginning balance, like December 1st, where would we pull that cash number from? Like, would we find it from,
Yeah.
you know what I mean?
Yeah,
like,
we would actually pull it from our November 30th balance sheet, right?
Okay.
So the end of the previous month.
Okay, so just go a month before and grab it from the balance sheet. Okay.
Yeah, in a problem, like in a textbook problem, it would just tell you the beginning cash was this much.
Okay.
A lot of times with accounting, like real life is actually easier than a class, because in a class, you have zero context. You just have this big nasty word problem to dig all this information out of. In real life, I know how much cash I had in my account at the beginning of the month, and I know how much cash I have at the end. I know if I'm buying or selling stuff, I don't have to read a problem. But yes, the short answer is the closing cash balance of November would equal the beginning cash balance of December. Other questions?
I have another question. Some of the questions that we have, it tells us that we're paying interest towards a loan. Is that considered an operating activity, or is that considered, I get messed up with that interest. Oh.
Yeah. Yeah, hence one of the reasons we don't typically do cash flow until later, because we learn all about how to calculate interest and what it means. But so the short answer is, typically speaking, interest paid on a loan is considered an part of our operating costs. Okay. And so interest expense we would put in our as part of our operating cash flows. But the loan itself, if we were like paying off the loan, that would be part of our financing cash flows.
Okay, so interest is operating, but if we're paying the whole loan off, it's finance.
Right. That's
activity.
That's if we pay the principal on the loan, right?
Okay.
So if you think about it, like a loan allows us to have an asset now instead of having to wait till we save up the money. And so we consider it financing when we get that asset or get that money to buy the asset. But the interest is like a cost, an ongoing monthly cost of having the asset to use now, because we borrowed.
Okay.
Well, we are coming up on 5 o'clock. Again, I know a few people added to this group, but you know, if you ever just need to leave, you can, and like nobody will judge you. Like if you have another thing to get to or whatever. I will say, you know, is there anybody who wanted me to look at a specific problem in the homework? And again, if somebody else if you have to leave, that's fine. But I will gladly go over a specific problem if you'd like. I saw a yes from Anne.
Okay. Can you help with the quiz?
Sure.
Okay.
It's open book and open my brain.
Okay, great. Okay, so number 7 on the quiz.
All right, give me a second to pull it up.
Okay.
I'm going to stop sharing my screen for a moment. Let's see. Oh, wait, I clicked the wrong thing. There it is, so that I can pull it up. Invariably, if I don't do that, like I'll be clicking through and like the grades thing will be there and everybody will see everybody else's grades and somebody will get all like, the teacher showed people my grades. So that's why I stopped sharing. It's not that I don't care. It's not that I'm not a sharer deep in my soul. Okay. So we're looking at the quiz. Number 7. All right. And I am going to share my screen again. Let's see, this guy right here.
Yeah.
So mine will have numbers on it, but recognize they might be different than yours because they're algorithmic. The system like changes them up. So like, I mean, take a screenshot of that and just put it in there at your own peril, I guess is what I'm saying.
So what I'm struggling with is number 4, 5, and 8. They're the credit questions. So I have, what I've gotten correct is where to put them on the balance sheet, but I don't have them right on the statement of cash flows. So are we supposed to put our second number, can it be either on the income statement or the statement of cash flows, or they need to go on the statement of cash flows?
So you can see right here, can you see what I have up?
Yeah.
So if it's on credit, it doesn't go on the statement of cash flows because there's no cash changing hands.
Oh, okay. That's why I'm getting messed up with this whole credit thing. Okay.
Yeah. So like the purchase of equipment on credit is just in essence an increase to an asset, equipment, and an increase to a liability, you know, whatever we're going to call it, notes payable or accounts payable, depending on the nature of the credit arrangement we make with the person we bought it from. The purchase of supplies on credit is just an increase to the assets and an increase to the liability, no effect on cash flows. Does that make sense? Because no cash is changing hands.
Okay, so, okay, now I understand it. So you know, this is week 2. So I'm just noticing that the balance sheet is the balance sheet. And then I have the income statement. And then I have the statement of cash flows. I was thinking that I had to put something on each one of them. Like
okay.
Like the balance sheet, I had to have a figure of the income statement. I had to have a figure on the statement of cash flows. I got it. Yeah, this is week 2.
No, that's good.
I'll get it.
That's the whole reason for this class. And I promise you, you're not the only one. So hopefully someone will watch this video later and be like, oh, that's helpful.
Okay, so knowing this will probably help me answer the 3 questions I still haven't answered yet. I haven't figured them out. Okay.
Okay.
Thank you.
All right.
Put a plug-in for that number 11, the computing net income using the accounting equation.
Sure. And I will say that in my additional study resources, there was like a full video of me working that thing out.
Yep, and I saw that when you were doing that presentation, so I'm totally going to watch that too.
But I will gladly just kind of talk through it real quick here. So here it is, problem 1-5A, preparing a balance sheet. Is that the one? Or is it on the quiz access?
It's on the quiz access.
Quiz access, yeah.
Was that the one that you had to have the like statement of retained earnings?
So it's talking about, like, it tells you the total assets at the beginning of the year, the end of the year, total liabilities, and then you're supposed to find the net income or loss with the 3 different scenarios.
Yeah, that's where I was actually, it took me probably about 30 or 45 minutes. And then I realized that I was missing a piece of the puzzle.
So let's see. Is this the one? That looks different. Well, that's it, right?
That's the one.
Right. So what they're giving us is our total assets at the beginning of the year and our total liabilities at the end of the year. And then they're also telling us that additional common stock or whatever. And it also tells us to consider each of these as separate situations. So in essence, the way you have to kind of deal with this, let me bring up an Excel spreadsheet. Oh, Excel, what would my life be without you?
I love Excel.
Yeah.
For myself, I actually kind of like went past that problem and went forward. And then I saw something in the work that we were doing later that made me go back and go, oh, this makes sense now.
Right.
Yeah.
So, and there's a lot of that in accounting. Like if you get stuck, like moving forward, and then you'll be like, oh, that makes sense. But it doesn't always feel that way in the moment. Okay. So the first one, our assets at the beginning of the year were 53,200. At the end of the year, they're 84,000. So I'm going to just compute here the change in the assets. So my assets went up by 30,800 during the year. My liabilities were 3,600 at the beginning of the year, 23,600 at the end of the year. So My liabilities increased by 1,300. Now we know that the net income, or I'm sorry, the equity is our capital stock minus our dividends plus our revenue minus our expense. So we know that additional cap, so this right here, this represents the change, right, in assets and liabilities. Because it's the end of the year minus the beginning of the year. And the end of the year minus the beginning of the year, the change in liabilities. So the change in our capital stock was that it increased by 4,600. And the dividends that were paid during the year were minus 8,600. So now we have just an algebraic problem because we know that revenue minus expenses is our net income. So I can solve this in essence just by saying, remember, it's assets equal liabilities plus equity. So if I want to solve for what my net income is, I would just say, well, it's my assets minus my liabilities plus, I'm sorry, minus my common stock. And then we're going to say plus our dividends. Since that's a negative, we actually have to say minus. That's confusing, sorry. So that gives us that our net income equals 21,800. I don't know if that helps, but in essence, what we're doing is creating like this little algebra problem where we just have one variable to solve for. And so we're going to calculate the difference in our assets and our liabilities. Then we know the change to our common stock and the change to our dividends. And then we just solve for net income. Does that help or not? Does that make it more confusing?
No, I think that you got my brain thinking now.
Okay. I know sometimes I'll try to explain something and I'll feel like I really explained it good. And then the person's just looking at you like, that's worse, man. Sorry.
When I looked at the retained earnings statement, I think that's whenever I had that aha moment. Like, right. Oh, here's all the places where those numbers would go. So I basically did the same thing you did, but not with the Excel.
Right. No, and well, I just did it on here because I can't handwrite it on here, but like a statement of retained earnings exactly summarizes this whole thing. Right. The change, how the change in our common stock and dividends is going to impact, you know, that sort of interrelationship between all the equity accounts. So I hope that was helpful. If not, check out that video. I think I did it a little bit differently there. All right, it is 5:09 where I'm at, which means it's later where everybody else is at except for Gage because he's in California. So are we good to go for tonight, or any other questions?
I was going to ask
with the two Daphnes, please.
Hey.
All right, go ahead. Sorry.
My question is about the exams. Like, if you were me and you were going through all this material, would there be an algorithm or something that we would need to focus on, or is there a study guide or anything like that prior to exams?
Yeah. So if you go into the module, I'll show you where to find it. And actually, I've added it to the additional study content right here. Whoops. And so you'll see right here, like debit and credit rules study guide. And then when we get down to exam 1, there's an exam review. And this exam review is actually, like, I didn't create it. It's created by the course designers, but I have looked at the exam. And so like the first exam is chapters 1, 2, 11, and 12. And so it breaks it down by each chapter. Exam 1, chapter 1, and it says know all of these things. Critical review of these concepts. Chapter 2, chapter 11, and chapter 12. And I can tell you after looking at the exam that, like here where it says like know the primary objective of financial accounting, what they did is they just looked at each question in that exam and were like, you know, the question was probably like, what is the primary objective of financial accounting? And so they like made these bullet points based on that. So if you study these and know the answer to these, you're at least going to get the ones that are like, I'll call them like knowledge-based questions, right? They're not based on, they're not based on calculations. For sure. And then also it's gonna give you a good idea of what calculations to make sure you're comfortable doing. Does that help?
Yes.
Okay.
And it's open book and everything, right?
No, the exams are not open book. So,
not open book. Okay.
Right. The quizzes and the quiz access and all of the other work in the course is open book, but the exams are not.
Okay.
I know it stinks.
It's all good.
Again,
so far I've been pretty comfortable with the material. There's only been like a couple that I've even had to like think very hard about. Because I like already work in an accounting department, but I'm like not in the financial portion of it, but still like the concepts, you know, make sense.
Right.
Yeah.
All right. Where are you at, Daphne?
I'm in Texas, Dallas-Fort Worth area.
Well, that accent sounds further east to me, so I guess I didn't peg it.
The accent is from Louisiana.
Okay.
I was born and raised in Western Louisiana, where the Duck Dynasty people are from. And then whenever I was in high school, my dad moved me to Crossett, Arkansas, which is like South Arkansas. So I got a little bit of a twang in there.
That didn't sound quite like Dallas.
You can take the girl out of the country, but you can't take the country out of the girl.
That's right. All right. And other Daphne? I don't know.
The other Daphne is from Alaska.
From Alaska. Okay. So I don't hear like an Alaska accent. I don't know what the Alaska accent is, but it seems like that's a place that's so mixed. People have all moved there from different places that the accent is relatively neutral. And you'll hear like all sorts of examples of, you know, like the northern kind of Canadian accent, but it's much more toned down than that. That's been my experience with Alaska, but it's limited.
We are the biggest melting pot in the world.
Yep.
There is
everybody who's searching for adventure.
Spoken.
Yeah. That's awesome. All right.
All right. Thank you.
Are we good, or any other questions?
That's it. Thank you so much.
All right. Do you mind if I offer a closing prayer before we go?
Go for it.
You're like, man, should have got out earlier. All right.
No, I like the prayer.
All right. Our dear Father in heaven, we are grateful for the blessing of technology and how it allows us to meet across long distances, allows us to gain an education that would be very difficult to gain for many people otherwise. We're grateful for a group of people who are coming together with a single goal to learn and to grow as thou hast commanded us to do. Father, as we each seek to learn this material and to keep thy commandments, we ask for a blessing that those participating can learn what they need to. We love thee, and we're grateful for this opportunity that we have to meet together. And we say this in the name of Jesus Christ. Amen. All right.
Thank you.
Thank you. Have a great night.
Thank you.
Bye-bye.
Bye-bye.